a very warm welcome to everybody. I am Shrija Agrawal and you are watching yet another episode of Mint Inside. The year 2020 has really begun with a bang. We saw a very high profile consolidation in the food tech space. We saw Zomato, the homegrown food tech unicorn, actually acquiring Uber Eats. This is the first instance where two large unicorns have actually come together in a bid to sort of consolidate and also be profitable. With me is Rahul Khanna, who is the founder and managing partner of venture debt firm Trifecta Capital. Rahul, thank you and welcome to our newsroom.
Thank you.
Rahul, I want to sort of understand your views on this, that blitz scaling is a strategy. The famous Silicon Valley growth doctrine has really come under scanner for a variety of reasons.
Sure.
There have been so much drumming about the Silicon Valley torchbearer startups, which have not necessarily done so well in the public markets. And we're also seeing this first instance of this high profile consolidation in the food tech space. So are we seeing, the growing instance of startups and VCs coming together in the bid to become more profitable?
So, we have seen in the past that, as industries evolve, either there's a rule of three or a rule of two. It seems like, at least on the consumer side, the markets tend to be shallow in terms of the number of players. And as it's taking a lot of money to build these businesses, investors also rally around a few companies. Obviously in the food tech space, Swiggy and Zomato have been at it for some time, and they both have pursued different strategies to over time become profitable. Consolidation is a natural part of the evolution of the market, and it seems like as the number of players come down, the competitive intensity reduces, and maybe some of that pricing pressure goes away.
But who needed this more? Is it Zomato or Uber? What do you think? Of course, for Uber globally, they want to cut down their losses. But do you think it's necessarily a big win for Zomato? What do you think?
When you look at the results of Uber globally, they've been putting a lot of focus on Uber Eats because it seems like that's a business that they can grow quite aggressively. I think maybe they took stock of where they are in India versus some of the larger players on the ground and decided that maybe it's better off just merging the business here. Obviously Uber has had to take some tough decisions in other parts of the world, including China and Singapore, where they've had to take a step back. So, I don't know who needed it more, but it seems like they were both happy to come together.
You mentioned that, there's always been some bit of duopoly emerging in the consumer space, for instance. So what happened to this entire winner takes all philosophy then? What happens to that paradigm?
That's true. So in businesses where there's a high network effect, so like a Facebook or an Instagram or a WhatsApp, there's very little room for number two or number three, because effectively those businesses are entirely network effect driven. When you look at countries like Indonesia, Vietnam, to some extent Thailand, they probably have more in common with India than they do with the US. And so we see similar patterns of innovation where it's largely around using tech as opposed to core tech innovation like you see in the Valley, right? And so the application of technology to transport, education. So there will be a Revigo of Indonesia, there'll be a Byju's of Indonesia.
That's interesting.
So they will all come because they are solving very similar challenges that we have here.
Rahul, tell me one thing. You mentioned about the fact that, for Indonesia, perhaps India is the parallel.
Yes.
When we talk about the Indian startup VC ecosystem, I remember the entire conversation earlier was more towards US.
Yes.
Now it's geared towards China.
Right.
So what are we talking about right now in the VC fraternity?
So as we looked at kind of the first wave of investing, it was trying to build homegrown platforms. Over time, some of them will survive, some of them will get consolidated. I think as an example, Ola's done a great job of building a platform in transport. They took on Uber face to face, and I think they out-executed on consumer insight. So whether it was booking a cab in advance, paying by cash, putting entertainment in the cab, these are all insight-driven innovations done bottoms up. So I think that, while global platforms have the advantage of capital, possibly longer duration vision, some of the Indian platforms hopefully have better knowledge of the Indian consumer, and over time maybe will get acquired by some of these larger players. So I think the VC community is increasingly looking at where is the next wave of opportunity. Is it in education? Is it in healthcare? Is it in food? Is it in transport? Because I think the waves of shared economy, food tech, fintech, a lot of that seems to have passed behind us, at least for early stage.
So where do you see the next wave of startups coming from in the VC space? Is it more B2B and software, you say?
So we are definitely seeing a lot more interest in B2B. We're seeing a lot more interest in enterprise software. I think people do acknowledge that those businesses are built for the world not just for India.
It's interesting you mentioned about the fact that now VCs have a realization about the software companies.
Yes.
But tell me more about this entire VC investment trends.
Sure.
For instance, is there a conversation more with portfolio companies that you have to gear towards profitability or a public listing, and
Sure.
and does that come under what happened with SoftBank, for instance?
Clearly the message that SoftBank sent its companies was, profitability is important, sustainability is important. I think that, there's always a fine balance between chasing growth and chasing profitability. I think if you chase profitability too soon, the company is less attractive for follow-on investors. If you chase only growth, you may not raise the next round of funding. So I don't think there's a perfect answer.
So what role does venture debt play in
Sure.
this, in mobilizing capital entrepreneurship?
So that's a great question, because education remotely, it's not going to be purely online, it's not going to be purely offline. It's going to be some combination of a classroom plus technology plus services. Now, all of these businesses, therefore, need capex, they need deposits, they need working capital, they will have receivables, they will have lumpy cash flows. And so rather than financing that all with equity, we think that any good business should use debt as long as it understands that the use of proceeds is debt-like. And so if they can find a way to earn it back, so rather than funding deposits when you're opening stores, why not use debt to fund those deposits? Because over time you can release that capital.
So venture debt is suitable for some kind of models, are you saying that?
Yes, so I would say that, in companies that have achieved certain scale, where there is good unit economics, there is a path to actually them being able to either get to one more round of funding or get to profitability, and the business has aspects of financing that merit debt. They should absolutely take it.
From the entrepreneurs also, is venture debt still a difficult sell to startups, or is it like a more comfortable sell right now?
It definitely, in the early years, I think there was not a great understanding of the use cases of venture debt. It was principally seen as extending runway. Now, sure, us providing another 5 million on top of 15 to a company extends their runway. But what it really does is it actually brings down the cost of capital. It reduces the dilution. And specifically, from a Trifecta perspective, it brings a set of capital and relationships.
But Rahul, tell me, my last question to you really is that at a time when there's so much venture capital being flooded,
Yes.
venture equity, do you really need a venture debt proposition?
Sure. I think, at the end of the day, the best companies never stop raising capital. Start small. You don't necessarily need to take a disproportionate amount of debt. But as you grow, we can support you in your growth.
If you were to give me like 3 defining trends for 2020 for the VC industry,
Sure.
what would those be in terms of what's in the top of the mind of VC that we gear towards this new year?
Make sure that you're well funded through 2020, because for great companies, there's a lot of money, but if you're one level below that, then rounds can take a lot longer. So that's one message. 2, I think there is this recurring build for Bharat, which is, I think VCs are going broader into saying, what are the big challenges? So suddenly agri-tech is getting a lot more attention, right? Things that we didn't see as getting top of mind are now back in flavor. So there's a little bit more of searching for the next big theme, because it's not as obvious that you can put it into a bucket that came from somewhere else. And the third, I guess, is, there is really an appreciation that this is an industry that's in its teens. And so, there's a cycle of new managers getting created.
The money is green,
Sure.
right? For any startup, whether you
Sure.
raise money from an equity firm or you raise
Right.
money from a debt firm,
Sure.
how does one, establish differentiation amongst
Sure.
VC firms, right? Ultimately,
Yeah.
capital is a commodity, right?
At Trifecta, we think about ourselves as a long-term partner to businesses. So while we start with venture debt, our view is that we really want to be their partners in growth. And as they grow, they will need 3 things. One, they will need incremental credit. Some of that credit will come from us. Some of that credit will come from our investors, who include banks, NBFCs. So we really think about us being in the solutions business for credit. 2, these companies will need advice and support. And through our deep networks in the old economy, we hopefully can get them the right kind of advice and support, including being able to connect with very large business conglomerates that may provide them a running start on distribution and things like that. And 3, we think that over time, these companies need more focus on financial engineering. One of the things we've rolled out at Trifecta is the ability to help them manage their treasuries better.
You know, the kind of messaging one gets is
Yes.
that perhaps venture equity is more prone to sort of, you know, funding cash burn.
Sure,
Venture debt would not
by
be.
design it is, and I think that is absolutely right. You know, the job of a good venture capital fund is to take lots of risk. The job of a good venture debt provider is to take very little risk.
Thank you, Rahul. Thank you
Thank
so
you.
much for sharing those insights. So that's a resounding message coming from this conversation. Different kind of businesses require different forms of capital. If you're opting for venture debt, be sure that it has a growth equity approach to venture investing. That's a wrap from my end. Till the time we see you next, goodbye and good luck.